What is up, everybody? Welcome back to another episode of Bitcoin and Markets. My name is Ansel Linder. This is a weekend live stream. Man, I don't think I've ever done a weekend live stream. I didn't get my Freeform Friday in, so I wanted to do a show on the weekend, and we'll see how this goes. If you're new to my content, pretty much the longest running Bitcoin macro show. Started back in 2016. And I have a lot of correct calls to my name here. I don't do a lot of interviews on my show, or really any interviews. We do interviews sometimes on FedWatch, but not for a while. And mostly we talk about macro, we talk about Bitcoin, we talk about all of these things. And like today, we react to stuff. So today, what I want to do is one of the listeners sent in, asked a question on Twitter DMs. And so in there, he was asking about my deflationary thesis, if I've ever, or what do I think about other macro commentators in the space, and asked me about Keith Weiner, and I never have heard of him. And so then he's like, oh, he did a debate with Pierre Rochard a while back, gold versus Bitcoin. And he's somewhat a deflation, or has a somewhat of a deflation narrative like myself. And so I'd never heard of him, found this debate, listened to it, and I wanted to react. I mean, I think that Pierre Rochard did an exceptional job. He is a gem for the Bitcoin space, extremely, extremely valuable person to have in Bitcoin. So he did a great job. We'll listen to his comments too, or his rebuttal, whatever, during this debate. But the main thing I wanted to respond to is Keith Weiner and his anti-Bitcoin comments, pro-gold comments, from my unique deflationary perspective. So that's what we have on deck today. What you're seeing here is bitcoinandmarkets.com. You can sign up for the free membership and get my weekly newsletter. It goes out every Monday. I also have paid memberships to help support my content financially and help to make this a sustainable full-time thing. We'll see if I can ever get there, but love doing the show. Love the community over on Telegram. Check it out at t.me/Bitcoin and Markets. Guys cutting it up in there all of the time. So super appreciate that kind of quiet from the storm, if you will. It's like-minded people. There's a few things people disagree with, and there's a few people that are more outspoken than other people, but it's a good place to have a little bit smaller community, not like a big Twitter, global community. It's a small community just for my content. But yeah, I love Telegram, as you can tell. T.me/Bitcoin and Markets. Okay, let's go to, should we check the price? Should we check the price before we go into this? Because price is everything. Here we go. Sharing on the screen the price chart. It's up a little bit, green on the day. We'll see if we can break out here. It's 27,266. I'm going to hide some of these things here. If we can break above this line, let me bring the 50-day moving average up. Think. Where are you? Okay, there we go. So if we can get above the 50-day moving average, which is sitting at 28,200, and this red diagonal downward trend, if we can break up above that to 28,500, then I will consider this a new breakout, and we'll see where the new highs are. One of the things I talk about all the time is when we have resistance like this, that's usually quite strong. And you can see that, the resistance up here in this red zone is this recent top. There's a couple other pieces of resistance. If we go back and zoom out, let me go to the weekly. You can see where that resistance is coming from for that red bar. It's coming all the way back from the end of 2020 into 2021. And even in 2022, we had a pause in this zone at about 30,000. And that's right where we found our resistance. Now, if we can keep chipping away at that, because there will be bids and things and levels. And if the more times you hit an important level, the more you chew through those orders on the exchanges, and the more likely you are to break through. So if we found support once again here, as you can see on the 200-week moving average, and we might be able to break up, test that 30,000 once again, and we will have a better chance of breaking through this time. My ultimate targets have been the same for a while. My targets are pretty much focused around the end of Q3, because I think that is seasonality. With seasonality, there's going to be a lot more volatility around the end of Q3 this year. So my target is for the end of Q3. And if you want to know what that is, got to join the Market Pro tier. So Premium Market Pro at bitcoinandmarkets.com. I do my premium newsletter. Okay, let's get back into what we came here for, and that is Reason Magazine hosting the Soho Forum debate, Keith Weiner versus Pierre Rochard. And we'll listen to this resolution, what the resolution is that they're debating over, and then I have some comments on that. So let's go ahead, make sure everything is lined up. If you're listening on Telegram, guys, this should come through the audio, and you're seeing Inception right now because I had to share a window so that, and I didn't want to share like the back end of the browser that I'm in. So I just am sharing this screen, and it's kind of like Inception, but you'll be able to hear the audio come through, I'm pretty sure. So, okay, let's go and start this up.
Without any further ado, I want to remind you of the resolution. Gold will remain an important form of money in the 21st century. Please vote initially yes, no, or undecided on the resolution. Here to defend the resolution, Keith Weiner. Keith, please come to the stage.
Okay, initially here, the resolution: will gold be an important currency at the end of the century? I don't like that they use the word important. What does that mean exactly? It's subjective. I actually might take the affirmative here. I don't think that gold is going away. What exactly is important? I mean, some people, we still use barter, right? Like if a friend does a favor for you, you pay him in a 6-pack of beer or something. So there's barter all over. Or you let me use your ladder. I need the ladder for something, and my neighbor has a ladder, so I'm going to borrow a ladder from them, and then my wife will bake them a dozen cookies or something. I don't know, but there's barter going on everywhere. There's people using silver. I mean, I haven't seen this in many years, but when I was a gold bug, people would walk around with silver. You know, I know people that walk around with silver coins in their pocket because they tried to use silver for everything. So what does an important money mean? Another thing I would say to this too is Latin an important language? I mean, nobody speaks it on a day-to-day basis. I mean, it's used right in some Catholic churches, I think, still use it, but it's not like used anywhere, but it's still very important. So what is this resolution is very poorly worded. Important money. But okay, let's get on with this. As you can see, I'm going to be talking a lot. So we'll see how long this live stream takes me. Okay, let's go.
Taking the negative on the resolution, Pierre Rochard. Pierre, please come to the stage.
Yay, Pierre. Boss.
Okay, I hope you've all voted yes, no, or undecided on the resolution. Connor, please close the voting. Keith, you have 15 minutes to defend the resolution. Take it away, Keith.
While everybody is panicking and selling their crypto, me and many of my friends, students, and private clients are making...
Here we go.
If this debate were about which asset is better at skyrocketing, also crashing, then I would shake my opponent's hand, concede, and walk off the stage, because Bitcoin is obviously superior at skyrocketing and also crashing.
Puke. I mean, what a simplistic, simpleton argument to start off with. Maybe he's thinking that this is his audience that he's preaching to, but just such a horrible thing. And that wouldn't even concede the resolution, because, well, I guess he said if the resolution was, is Bitcoin better at pumping? Yeah, of course, because that is a completely different thing. But we're talking about what he he's also trying to say that pumpability, pumpamentals of Bitcoin is a negative. I don't know how he gets there, but let's listen.
However, that is not the debate. The debate is gold will remain an important form of money in the 21st century. Ladies and gentlemen, our esteemed moderator, Gene Epstein, my honored opponent, Pierre Rochard, in a way, this debate is a bit unfair, because gold has been doing what it does for 5,000 years, and the proposition is that it's going to continue doing for the next 100 years what it's been doing for 5,000 years.
Okay, this is not correct. You often hear this, and Pierre Rochard later on, he actually tries to correct this by moving it to 3,000 years, because it definitely has not been a major money for 5,000 years. Guaranteed. It was a form of money, but it wasn't even the most important form of money. You know, you can go back to Sumerian tablets. I mean, the first ever gold jewelry is very old. They dug some up in Siberia, I think. Gold rings or something like that, or spirals. So it's been a long-term form of money, but it has not been the form of money, the most important form of money for 5,000 years. No way. It started just being coined like in what was it, 650 or 500 BC, roughly. And the first coins were not gold. Okay, the first coins were electrum, which is an alloy between gold and silver. The silver coins were much more popular. Copper was used. Iron was used. Ingots of all of these metals were used. So it's not 5,000 years. This is totally a non sequitur, because it's absolutely not true. What else do I have? I have some notes here. I'm just looking at these. Okay, so that's what I would say. And even at 500 BC, gold was not the main money. You know, the drachma, the silver drachma, was the main money. The silver denarius was the main money in Rome. Then they created the solidus, that was a gold coin, but that might have been just used for large value transactions and not for everyday use. It was, I would say, an important currency, but it was not nearly used like it was back in the year 1900, you know, when there was the classic gold standard. So he wants you to think that the world has been on a classic gold standard for 5,000 years, which is not at all the case. So once you start piecing or tearing that down or picking that apart, it's very easy to think that gold could go back to less important role. Will it still be important? Probably, just like Latin is still an important language, even though no one speaks it anymore. So the resolution is kind of wrong. But anyway, I just want to point that out, and let's keep going on this. I have a ton more to say.
In a certain sense, good luck to debunking that or arguing against that.
You wouldn't be arguing against that because it's wrong.
But there's a lot more to be said, obviously, about money and, and how all this works. So we live in a system where we have a failing dollar. I don't think that's very controversial in this audience. some audiences I speak to, you say that, people are like, what? And then the room breaks into pandemonium. But the dollar is designed, this is a feature, not a bug. I'll keep referring to this concept of feature, not a bug. The dollar is designed to go down. The Fed on its website says 2% per year, which they define as price stability.
Okay. So this is also wrong. The dollar is failing, he said. That's another subjective term. When I first listened to this, I was like, yeah, it is. But I mean, it's kind of like, my first thought was an orbiting body, right? It's constantly falling, but it's not like losing altitude, right? It's falling around the globe or the object, the planet. So yeah, you can have a constantly falling or failing thing, and it doesn't mean that it's getting worse. Okay. Another thing, he said that the dollar is designed to lose value. Designed by whom? He says he thinks it's the Fed. All right. But that's not the case. The Fed did not design the current dollar. They are flailing in the wind just like everybody else. Now, their 2% number, if it were designed to be 2%, why isn't it 2%? They undershot for 12 years after the great financial crisis, and then they majorly overshot. Like, has there ever been a single month where the year over year inflation, or even the annualized month to month inflation, would have been exactly 2%? No. So just because they say that on the website doesn't mean that they designed it or that the dollar was designed to be that way. It wasn't designed by anybody. It just happened that way. What else do I have to say about this? So they just picked a number, 2%, to, one, give the market something to set expectations around, and two, because that's kind of what it has been naturally, roughly 2%. If they set a goal at 5% and it was 1%, people would laugh and say they're not even in a charge. They're not even charged this. But if they set it at 2% and it sticks around 1.5%, they're close. And people can still believe in this false notion that the Fed designed and the Fed controls and the Fed they're omnipotent. So the Fed is not in control. It's not designed by anybody. The dollar is not really failing. And what I'll add to that also is not mentioned in any of these debates is the dollar has changed so much. Multiple times it's been, denominated in silver and gold, and different gold taken off of any backing. What's to say that they just can't reback it with a commodity? That's exactly what I think is going to happen. So the dollar is not going to fail, people. It can be rebacked. That's what happens all the time. All right, let's continue.
I wonder what Orwell would be saying about that. So the dollar is designed to go down at a steady rate. Why? As a free boon to borrowers.
Okay. See, that's the problem when you go down this rabbit hole thinking that the Fed is omnipotent. Because then you have to rationalize why would they do this? And it makes you think false things, reach false conclusions about their motives or about the way the system actually works or whatever, because you think it's designed and the Fed is omnipotent and they're doing this for a reason. No, the thing is, the Fed is floating just like we all are. They are trying to look competent so that they can somewhat set future expectations. That's it. So it's not designed to be a boon to borrowers. It is, in a certain sense, because it's credit-based money. and credit has to either expand or collapse. But it's not designed by anybody for anything in particular, right? It's just the way the market has evolved. The current dollar evolved. All right, let's keep going here.
You borrow money and then the dollar is going down, then what you owe the return of is falling in value. The longer the term of the loan, the greater the fall, the easier the burden on the debtors. And that is how the system, if I can use the word rigged, is rigged. Unfortunately.
Okay, rigged. Again, another term. Life isn't fair. I think he touches on that again a little bit later, but nothing is fair. Okay. And just because the market goes against you, like that's another thing. You start thinking that the market is purposely rigged because you think it's designed and controlled and operated and managed by the Fed. So they have to be actually manipulating this against your own self-interest. But that's not the case. Okay. This life isn't fair. The world works the way it works. Nature it's not nice. Nature is not nice. So, yeah, you could say that nature is rigged against the, certain animals that go extinct, or nature is rigged against an antelope when a lion eats it or something. But no, that's just the way the world is. It's not rigged. That's the way it works. So do I have anything else on this? He contradicted himself, but let's see if we keep going on this.
Fortunately, the doesn't do as they would wish.
Contradicts himself right there. It's rigged. They control it. They designed it. All right. But it doesn't work. I mean, he contradicts himself right away. So instead of thinking that, instead of saying, oh, it doesn't work the way they want it to, I must be wrong that it's rigged. I must be wrong that the Fed is in control. He doesn't think that, he wants to find another way that it's manipulated, or why their omnipotent control is actually just partially omnipotent or whatever. You can see how this gets complex very, very quickly because you start from the wrong premise.
Doesn't do as their theory would predict. And it isn't steady or stable. It is not a simple mechanism for robbing Peter to pay Paul, Peter being the lender on the other. So every trade has two sides. And there's Peter over here who's lending his savings to something and expecting to get that back with interest. Well, he's the one who's screwed when the dollar goes down. And then Paul over here, the borrower, is the one who wins when the dollar goes down. Unfortunately for Paul, it isn't a steady, linear, monotonic would be the term, progression of going down. It has wicked volatility to it. And as we see right now, the dollar is going up, not down, which means the borrowers are finding that their burden of debt is increasing, not decreasing. Oops.
Oops is right. So it's not designed. It's not controlled. It's just the way that the system works. I mean, he contradicts himself in the first 2 points that he made.
And they don't really understand their own system. And so they're running around worrying about inflation one day and then, yield curve inversion the next, and the dollar index and on and on and on with all this stuff. So savers, when they face this uncertainty, turn to the thing that they've turned to for 5,000 years, which is gold.
No, they don't. I mean, that's objectively wrong. They haven't turned to it for 5,000 years. That's silly to say that, because they've turned to a lot of things over 5,000 years. Gold they've turned to, yes, to a degree, but what about silver? What about land? What about titles? Investing yourself, trying to get invested in a title or have a title to some land. Skills, education, iron. Iron was a huge money that was used. Copper, of course. Electrum, ships, sailing ships, any sort of asset, durable asset that's an income producing asset. I mean, these are also what people saved in. So no, it's people for 5,000 years have not been turning to gold. Maybe you could say during the classic gold standard for about 100 years in there, people turned to gold. But come on. So you're going to put that 100 years of a classic gold standard against the 13 years of Bitcoin? Okay, now we're talking here. Now it's a little bit more comparable. Okay, what I said here in my notes is I don't think there's been a single year where people didn't save in anything else and only saved in gold. So his 5,000 years, people have turned to gold for 5,000 years. There hasn't been a single year that they haven't turned to other things as well. You know, it's kind of a silly argument to say, but all right, let's keep going.
Now, gold does not pay a return. Now, my company, Monetary Metals, that's actually what we do, is we pay investors a return. That proposition is growing. We're hiring. All kinds of good things are happening. I'm not really here to talk about my company, but generally, gold is not expected to pay a return. And the trade-off for that is it doesn't have a risk. It's the thing you have when you don't want to invest or speculate and take a risk. People turn to that, but if they want to get a return...
That's wrong. I didn't even catch this the first time through. That's wrong because unless you had to self-custody it, right? It's only not a risk. Well, there's still, even if you hold it, there's still a risk that the gold that you hold in your house could be stolen. You know, you could 6102 it. The government could confiscate it. You could bury it in the ground, but maybe there's a sinkhole and it takes your gold down to 10,000 feet or something. Who knows? You don't know. There is still a risk. And what Pierre says is, well, first he clarifies that and saying that this is uncertainty, not risk. But that Bitcoin has less uncertainty than gold in this respect, which is a very good point. Okay, let's keep going.
Then they have to go to the market. And unfortunately, part of the defect in the dollar is that the yield, the interest rate available to especially retail savers and investors has been taken away. They waged a war on interest, and unlike all the other wars on, this one they've actually won. It's all over but the shouting. The Fed is now still in the throes of pretending that it can raise interest rates, but in their so far early stages of attempting to do that, all sorts of problems are coming out, and they're going to be forced to reverse as they were in 2015, as they were in 2007, all over again.
Because they're in control, because they're omnipotent, because they designed the system and it works for you. It's rigged. So it's rigged. That's why they can't do it right. That's why they have to pivot all the time. That's why they're always late. That's why they never see a recession coming, because it's rigged by these omnipotent central planners. The dissonance you have to have in your head to believe that is, I believed it for a long time. Probably, let's see. I believed that probably for 10 years of my adult life. I was a gold bug. Then I found Bitcoin. And even in Bitcoin, I believed that for a long part of it. So I would say 15 years, I believed in this dissonance. But once you see it for what it is, that if the system is rigged, if it's designed, if the central planners are omnipotent and they can control the interest rates, why are they always wrong? Why are they always behind? Why don't they ever see a recession coming? Why can't they ever get 2%? They undershoot, then they overshoot. Well, if it's rigged and designed by these omnipotent people, they should be able to do it. The fact is they don't. They are riding the same waves that we are. All right, so that is destroying his this first part.
So people are turned, if they want a yield and they can't get a yield by financing productive, and then they're forced to turn to a surrogate for yield, which is speculation. So you have to go into the Fed's casino and you have to put your chips down, and you can bet on stocks, you can bet on real estate, you can bet on fiat currencies, You know, there's a bookie taking orders on everything from Turkish lira to euros and everything in between. You can bet on, obviously, bonds. You can even bet on Bitcoin. And folks, that is, dare I say, the shabby little secret, with all due respect, of Bitcoin. Its purpose is to be a chip in the Fed's casino for betting to make more dollars. That's what
all of this can still be applied to gold too. But what I want to say specifically about this, he says that if they want to preserve their purchasing power, they have to go into the market for a return. He contrasts this with financing a business versus speculation. But actually, that's the same thing. All right. So if you take out a loan to finance your business, you're speculating about the future of that, right? You can't necessarily lock in returns in that way. If you lend to somebody, you think that you have this fixed rate loan that you're going to get a return of 5%. But what if it was a subprime mortgage? You know, what if they default on you? That's part of the reason why there's the 5%. The other reason is time preference. So the risk is still there. Pierre makes this point. He says that speculation is an entrepreneurial activity, and that's what this investing in your business would be, right? It's all entrepreneurial speculation. And so these things are the exact same thing. And then he says that Bitcoin is a chip in the Fed's casino for betting to make more dollars. What do I have here on my notes? Okay, so this is the Fed's casino. Again, the omnipotent central planner. The Fed, this is not the Fed's casino. The Fed is not in control. If this is a casino, the Fed is just a party. You know, maybe they're the dealer or something. It's not the Fed's casino. They're along for the same game of chance, the same ride that you are. Okay, then what do I say? All money is speculation. Pierre talks about this. It's all about uncertainty. He also says something like income is consumed. Of course, that is incorrect. Financialized everything. Now, I do kind of agree with this. All right. That he gave the example of like Ferraris and art and you know, all of these things gain some, I hit my mic, sorry, gain some monetary premium in the system. I do agree with that. But that's not because of the Fed. It's because the form of the money is credit-based money at the end of a credit cycle, and there's a deflationary pressure, right? And it's that manifests itself, or can also be said, as a monetary shortage. The debt burden outweighs the return on investment. And so you're trying, the market naturally, the human animal naturally tries to monetize other things. Jeff Schneider has talked about this, you know, during a monetary shortage, you get monetary alternatives springing up. And that is where this monetary premium and financialization comes from. It comes from a societal move towards trying to find monetary value in other things. Now, this is different than inflation, guys. This actually, when I was thinking about this earlier, that this was like, wow, this actually explains the difference, because that's different than an inflationary financialization. Okay, so when during a high period of inflation, people will take that cash and they'll try to buy durable goods with it. Okay, so they're trying to preserve their purchasing power through the actual value of the things that they're buying. So that is not a financialization. That's not a trying to bet on the price appreciation and the creation of monetary value in another instrument. This is an inflationary degradation is more of just a flight to durable goods. And in a deflationary pressure or deflationary degradation, it's actually a flight towards monetary premium, trying to find that value, trying to hit the lottery on something, trying to speculate out there. In an inflationary environment, you don't speculate. You know that I'm going to buy this toaster or whatever, some durable good, because it will hold its value. I'm not speculating on that. Well, I mean, I guess it is kind of speculation because everything's speculation. But I mean, I'm not betting that the thing will gain value. I'm betting that the thing will keep its value relative to the currency. And that's not what's happening here with the financialization from a deflationary pressure. I hope that makes sense, because I think that is pretty profound and explains. It's like almost irrefutable at this point that is a deflationary type of circumstance versus an inflationary type of circumstance. So what else do I say here in my notes? Okay. We're kind of close to this in 2008 or 2007, maybe, with real estate, people thinking, oh, the real estate has never gone down year over year. It will always continue to go up. You can see that kind of mindset where it's an inflationary mindset that this thing is relative to dollars. It's always going up in value. But we don't have that mindset anymore. I mean, just look at the headlines. People are thinking we're in a major real estate bubble. Yes, we have commercial real estate crashing, but we had residential real estate crashing in the 2008 financial crisis. Then even now, people are thinking that these aren't going to go up forever, right? So there has to be, so that is not an inflationary mindset. So that inflationary stuff has not set in. That would be the one place I would say that it does or has gotten close to setting in to inflationary or being describable as an inflationary mindset. But overall, all of this stuff is a deflationary degradation. That's what happens. People search and speculate for monetary premium out there. Okay. What else do I say in my notes? That's it. Let's go.
It does that other things are increasingly perverted into doing. Equities have become that. Real estate has become that. Old artwork, old antique Ferraris, whiskey, wine,
there he says
you
it
name
there.
it. Everything has been financialized and turned into a bet in the casino. So let's look at Bitcoin now for a moment. Bitcoin is skyrocketing. Well, not at the moment. Today was down a few percent. But generally skyrocketing. It has been in quite a bull market. And that's not a bug, it's a feature.
Yep.
It is planned, so just as the dollar is planned to go down, Bitcoin is planned to go up. Sounds like a good deal, right? Buy this thing that's going up.
That's kind of correct, actually. But Bitcoin isn't planned, the dollar isn't planned to go down. That is naturally how it has evolved. So people that are new to my content, the dollar evolved this way naturally because at the end of World War II, there was a lot of new technology, and then especially with the new internet revolution, a telecommunication revolution, I should say, and computing revolution, there was a lot of ability to use credit for productive purposes, to get a high growth rate. But once we have saturated that technology, once we have saturated the credit market, now, what do they say? For every dollar, it takes $2 of debt for the government to get $1 more of GDP. And it keeps going down. It keeps, getting worse and worse. So the productivity of credit-based money was highly, it was explosive back in the middle of the 20th century. And that's one reason why we went off the gold standard, because money was just expanding like crazy. And it wasn't just expanding in the US. I mean, dollars were being printed all around the world. So you could make a loan in Frankfurt, Germany, denominated in dollars, and you printed dollars in Germany. And then what would they do? They would try to repatriate gold from the United States, or redeem it for gold from the United States. So they were just printing money anywhere in the world and trying to turn it into gold. And so the U.S. had to stop that, right? That's just a natural evolution of this. So anyway, the highly elastic form of money was very good for business. It was very good for growth. We grew more in the second half of the 20th century than pretty much way more than the entire rest of humanity combined, right? Because of this highly elastic credit and technology revolution that we had. But now we're at the end of that. And the money will evolve away again. It will evolve back to something more sound, because when you have a credit crisis, you're trying to flee to assets that don't have any counterparty risk, and that's why gold will get a bid, and that's why Bitcoin will get a bid. But of course, Bitcoin has much more explosive fundamentals than gold has. So, yeah, that's what I would say.
Who's on the other side of the trade? And the dollar, the going down benefits the borrower, and in Bitcoin, the going up benefits they're not really savers, we'll call them hodlers. Who's on the other side of the trade? Well, that's the problem. In Bitcoin, there is no creative or productive thing generated by Bitcoin. The only way that anybody makes any money is by selling their Bitcoin to fresh new money coming in. So I buy Bitcoin, I give my money away to this gentleman here. My money's gone. I don't get my money back. It is not a conversion of my dollars to Bitcoin. It is a trade. I give him my dollars, I get his Bitcoin, he's out. I'm hoping that it's going to go up. So far, Bitcoin's been in one hell of a bull market. Eventually, if you wait long enough, it does go up. Maybe. We'll see. This time may or may not be different. And then I sell to this gentleman over here. I don't get my dollars back. It's not a return of my capital. It's this gentleman giving me his capital, which converts to my income to be consumed. So it is a vehicle for conversion of one party's capital to another party's income to be consumed. Nobody wants to be a prodigal son, but speculation, and it isn't just Bitcoin, I mean, it's stocks, it's properties, it's whiskeys, it's everything, have become vehicles to make a prodigal society.
No. I don't know where to start. Like I had my order mixed up. That's where he said that it's consumed. The income is consumed. Money is not consumed. That's part of the deal. Money is it's an asset that carries value into the future. You don't actually consume it when you use it. You send it, you give it to somebody else, right? So is there any asset that wouldn't fit into his little series of transactions there? I don't think so. But, he's saying that, okay, it's all just a fixed pie world. It's just money sloshing around. But no, that's not the case. Okay. Value is created in the minds of men. Value is subjective. So here's an example. I have an apple to sell you, and a guy comes up to me. He's like, I'll give you $1 for that apple. I say, no. He says, oh, how about 2? I say, no, I'll take 3. Like, that price, that value was not created in any transaction. It was created in my mind, the value that has. Value is completely subjective. So he doesn't even understand money in the first part, or pricing. It's just, let's see what I say. Just looking at my notes here. All right, let's keep going, because I think he has something else coming up here.
We don't want to spend our own life savings down, or our family legacy down. We're spending somebody else's through the magic of what we feel is a market. But it's a rigged game, and everybody is forced to be there because the Fed has taken away yield. Everybody needs yield. You can't get yield one way. You turn to the surrogate, which is speculation.
Okay. That's incorrect. Like I have already stated, the Fed has taken away interest rates or yield. That's not the case. That's an interest rate fallacy. Is actually, as money becomes tighter, because returns on credit decrease, the diminishing marginal revenue product of debt, then lenders will be less likely to lend and borrowers will be less likely to borrow because they don't see any way to repay principal and interest. That's why interest rates go down, because you're narrowing the pool of potential borrowers. It's actually tightening of money. Credit standards tighten and demand goes down. So you narrow the window of where the new credit is going. That's why interest rates fall. So no, the Fed did not take this away. This game is not rigged in that way. I mean, yeah, it's rigged as in life's not fair, but it's not rigged by the Fed. And again, the searching for yield by investing in these things is people searching for a monetary premium in a monetary shortage. Trying to make some monetary premium happen. Okay, what else do I have written here? Okay, price. It's true that price is set on the margin, like he said there. But value is not set on the margin. Like I said, value comes from the minds of men. Price is just, he's conflating price and value. So, all right, let's keep going because I think he has something else to say here.
So Bitcoin is a zero-sum game, and it's actually negative-sum game because it costs a lot of money to run the Bitcoin network. I'm not an expert in this, but I've read a number that's something like tens of millions of dollars per day. The only source of funds to the folks who run the network are the new money coming in from new buyers.
Okay, this is wrong on so many ways. Okay, so zero-sum game. No. Voluntary markets are mutually beneficial, right? Voluntary exchange is mutually beneficial by definition. This is what Mises and the Mises Institute, what they preach all the time, is voluntary exchange is mutually beneficial. It's not a zero-sum game. So even if he was correct in his little arbitrary series of transactions that he said there is utility gained because it's a voluntary transaction. Okay? So it literally cannot be a zero-sum game. So he might respond to that, say, oh, the Fed forces us to do this, maybe because they change the rules or whatever from time to time. But that's not the same as literally forcing a transaction to take place. All right. As long as you have some control, some choice over your transactions, nobody's forcing people to buy Bitcoin. No one's forcing people to buy Apple stock or bonds. So as long as you have some choice, there's going to be some mutually beneficial thing happening in that trade. So it's not zero sum. It's not zero sum. Also, again, he conflates price and value. The market price is the clearing price, not the value of a good. So that's important to note. People don't spend their Bitcoin. Okay. Also, I thought of this when I was listening to this. So the people don't often spend their Bitcoin because the value of what you would get in return, people aren't willing to value Bitcoin high enough yet. So as soon as people are willing to value Bitcoin high enough, like let's say they could people were accepting Bitcoin at a market value of what $1 million is today, then people would spend their Bitcoin. So you can see that I think that I can buy a Bitcoin today for 27,000, but it's worth $1 million. Look at all that utility that I got. How do you measure that? How do you measure the utility that somebody gets from purchasing Bitcoin at a certain price? You can't, because it's subjective. See, that's why I'm saying he's conflating price with value. We don't know how much utility they're getting out of it. Only they do, and they really don't, because it's an ordinal value system. You can't put necessarily a price on it other than saying, I would pay $1 million, but I can't really check that that's true. I just feel that that's true because maybe I would take 900,000. You know what I mean? So it's all subjective. It's all a feeling, and it's impossible to measure the utility. But as long as it's a voluntary transaction, there's value being created there. Okay. So it's not that hard to get that part of it. But a lot of people think it's a zero-sum game. I mean, that's the socialist thing, is that it's zero-sum. All right, let's continue.
And so it's a system in which the system is the people that are exiting and the people that are running the network are eating the money, some of the money that's coming in, and then eventually, what happens when you run out. So,
all right, let me just mention too about the miner aspect of it, about supporting the miners. He says the only source of funds for miners is new money coming in from new buyers. But I don't think that's the case either. It's definitely not a one-to-one function, because value can be created in the minds of men, in the market. So not necessarily money coming in from new buyers. Now, if you want to say dollars, like they can only pay their electricity bill by the dollars that come in to buy the Bitcoin. Yeah, I guess that would be the case. But price doesn't move because new money is coming in. I think that's what he's trying to say here. Price does not move because new money is coming in. Price moves because subjective valuations go up, and the clearing price, or the marginal trade, is going higher because people's subjective values are going up for Bitcoin. So price is not going up because of new money coming in. It's going up because of subjective values. I hope I made that clear.
So, no, let's back for just a moment. You said savings will be at risk. Are you?
This is my one slide for today. Now, in a certain sense, you could say that's a trite tautology. Haha, 1 = 1. It doesn't mean anything. I've argued with many Bitcoin folks on Twitter in particular, and a lot of them will say 1 Bitcoin = 1 Bitcoin.
Yep.
And I challenge them, and I say, I don't think even you believe that if I had, let's say, a successful restaurant chain that was worth 10 million Bitcoins a decade or so ago, that it's undergone a hyper collapse down to a few tens of Bitcoins now.
Okay, well, what about gold? Gold has been it just recently hit a new all-time high, but it hit 1900 and went all the way down to 1,000. So, it dropped by almost 50%. So would he say that business the value of that business was cut in half or doubled just because gold went down? The same exact arguments can be made against gold than, the volatility of gold versus the volatility of Bitcoin. So yeah, 1 Bitcoin equals 1 Bitcoin. And as Bitcoin matures, which I think we'll get into here in a second, as Bitcoin matures, then it will become less volatile. And not everyone buys that, but we'll touch on that in just a second.
I don't think anybody really believes that. You realize that it's the unit of measure that's shifting and not the value of the thing being measured. So I want to look at this and what this means in terms of gold, because it's not just simply a tautology. I'm not just simply saying 1 ounce = 1 ounce. Austrian economics
Wait, that's exactly what he's saying.
teaches us that as the quantity of a commodity increases, its utility or value at the margin decreases. I live in Phoenix. It's a very hot desert. This time of year, you could expect temperatures of 115 degrees in the shade. If you're walking around in the afternoon in the sun, you will go from perfectly happy to thirsting to death, within an hour or so. If you come across somebody offering to sell you water, what is the price you're willing to pay for that water? For the first liter, you'd open not just your wallet, your bank account. The second, the third, by the fourth liter, you would refuse it. Everything has a utility that is diminishing at the margin. Gold is not consumed, and it's been continuously mined, so far as we know, for at least 5,000 years. And in those 5,000 years, we have not reached the point where marginal benefit is less than marginal cost. We continue to accumulate more of it without any apparent limit. And what this is saying is that at the margin, gold's utility is not diminishing. The nth plus 1 ounce has the same value as the nth ounce, which is saying that gold is the closest thing we have to a economic constant.
Okay. Now, gold definitely has diminishing marginal utility, 100%. We just haven't reached that yet, right? It's the big difference between saying there's no apparent limit and that there is no limit. It's the same way we could say with the water example. He used gigantic measurements, a liter, because you can quench your thirst with a liter. But what if we used teaspoon or molecule of water? The apparent, diminishing marginal return would be very hard to identify, right? So no, gold is not magic. Gold does not have lack diminishing marginal returns. It's just that we're not having enough of it yet. But I'll also say that, I don't think anybody would argue if gold or if the U.S. government dumped its 8,000 tons of gold on the market, that we wouldn't see diminishing marginal returns. It's just kind of a silly argument. Or if some space aliens came and dropped, because they say all gold ever mined is a cube that's 21 meters, a cube 21 meters across. What if aliens came and dumped gold that was 500 meters across, a cube that was 500 meters across, hyperinflating the gold supply? Would anybody ever say that is not going to see diminishing marginal returns? No, of course not. I also think that he's conflating the market process. He's conflating the market process for the stability that the market process provides to gold for a inherent property in the gold itself. So let's keep going because he says something about that.
Now, compared to Bitcoin, is this true for Bitcoin? We don't know. In fact, we don't have a way to know, because the central planner who designed Bitcoin was terrified that this coin and set a hard cap at 21 million units.
Okay, so this is a disingenuous argument because central planning is an ongoing process, right? Central planning is an ongoing process. And so since Bitcoin is not being centrally planned today, he tries to say that Satoshi centrally planned, or Satoshi is the central planner. But to be a central planner, you have to be ongoing in the process of central planning. If there's no central planning happening, there's no central planner. I hope it's a disingenuous argument to be made. So, and Bitcoiners are not terrified of tail emission. It's just that it's monetary. The arguments for it are, well, it creates a vulnerability to that coin. just like gold's tail emission creates a vulnerability to gold of a harder currency coming in, right? So it has to be fixed. So the supply has to be fixed. It's not that you're terrified of it. It's that the logical arguments take you there, right? Because if there's a harder currency than Bitcoin's decentralization breaks down. So you need to have fixed supply. It's like that linchpin. It's one of the linchpins that you can't take out, or everything comes across or comes falling down in the Bitcoin system. And that is actually a weakness of gold, the same way it would be a weakness for Bitcoin. So anyway, let's keep going.
So we can't run a 5,000-year experiment to see what happens if Bitcoin's quantity keeps increasing. To put this in perspective, every year the miners...
Well, yeah, we can kind of, right? We could do a computer simulation. It wouldn't be perfect, obviously, but we could do that. And you can just use deductive reasoning. I mean, an experiment doesn't have to be like a real true life experiment. We can do an experiment in any sorts of ways, a thought experiment. That's why it's called a thought experiment.
Produce about 3,000 tons of gold, which is worth about $170 billion. That's over half of Bitcoin's current market cap, being produced every year in gold.
What a weakness.
And yet, this is still true. Gold's utility at the margin is undiminished.
That's incorrect, man. How are you measuring that? I mean, it's just so wrong.
Now, why is it important to have something that's an economic constant? If you look at the firm, if you look at the enterprise, what is the single most important thing that every business owner, operator, manager needs to know? Are we creating wealth? Are we destroying wealth? And how do we measure that? If the very unit in which we measure it is either designed to go down monotonically and have some wicked volatility along the way, or something that has gigantic volatility and gyrations, we would never know whether it was the change in the unit that restaurant went from 10 million Bitcoins to 40 Bitcoins in value, or whether it was actually the business that went down. You need something that will give you an objective picture, and gold is that objective picture.
Okay. Gold is that objective picture. Gold's magic. Gold is has magical properties. It's the objective picture that is perfectly tells you the market value at any moment in time of anything. Inherent in gold, or I guess inherent in the atom, the gold atom, is this magical property of no diminishing marginal returns ever. It's immune to all that. No, of course, that's incorrect. Gold is mined at a sustainable rate because the market balances diminishing marginal returns with supply and demand. It's the market doing that, not gold. Gold has some properties that make it easier to do for the market processes to work a certain way on that certain metal, but it's not the gold itself that's the objective picture. Okay, it's the market process. The market is creating the stability in the asset. I also think that he is conflating supply, total supply, with circulating supply, which I think we'll get into here in a little bit. But that's a stabilizing factor as well for gold. Is, like when gold pumps, you'll usually see these kind of gold dealers that will take all your old gold jewelry for cash and all this stuff. I mean, the circulating supply of monetary gold can be adjusted versus the total supply of gold. And he's like, oh, every ounce of gold is still held by man. No, it's not. There's shipwrecks, right? There's lots of lost treasure out there from the Spanish galleons and all that. So no, that's not the case either. What else? I think I'm going to get into the circulating supply versus total supply in the next section. Let's see. So I would just, to sum up that part, no, gold isn't magic. It's a market process. The market is what's providing the objective picture through gold, through the money. It can do that through Bitcoin the same way. It's just that gold is more monetized than Bitcoin is. We were talking on the server about if gold is going to be demonetized anytime soon because of this, by the year 2100. And I don't think it will be completely. Some people were saying that it will be completely demonetized by then. But I don't think it will completely lose its monetary premium, but it will lose a lot of it, maybe like 99% or something. But I don't think it will ever be completely demonetized. It's a hard question, but yeah, okay. The next part, he is talking about the 21 million. So let's get into that.
One other problem with Bitcoin, I say the word again, centrally planned, is that somebody, we don't necessarily know who Satoshi is, we think we know at this point, decided that 21 million was the magic right number of Bitcoins. He decided 22 million is not the magic right number, and 20 million is right out. It kind of feels like Monty Python and the Holy Grail, if you remember the Holy Hand Grenade of Antioch, right? Well, what if that's not right? He also decided that as Bitcoin approaches this 21 million, it is to approach asymptotically. What if that wasn't right? What if it should be linear? What if it should be the other way? These are things that have been decided by a single person, or maybe a small group of people of Satoshi's group, and they constitute Bitcoin's central plan. And the net result.
Okay. Bitcoin is not centrally planned. Like, would you say that gold is centrally planned? No, of course not. Even though gold, if you believe in a creator, or even if you don't believe in a creator, let's say you believe in supernova create gold, or however you say that. But just because it's created at some point doesn't mean that it's actively being centrally planned. For a central planner, you need to have ongoing central planning. If you don't have ongoing central planning, there is no central planner. So Satoshi did create the certain characteristics of Bitcoin, but it's not arbitrary. All right. The 21 million is not arbitrary. It's a combination of block time, and block time was not arbitrary either, not 100% arbitrary. It could have been 9.5 minutes or 10.5 minutes, but it's not arbitrary either, because it needed to be long enough for the competition to go on, the burning of energy, as well as the latency of the network to make sure everything is shared around the world, and that kind of thing. So it's not arbitrary, 100% arbitrary. The block time isn't. The halving cycle, this was not arbitrary either, because depending on how fast you want to get to the end of the issuance, or how fast you think that the adoption will happen, it's not like he just picked 2,000 or 210,000 blocks out of a hat. This was not arbitrary. It was thought about why it would need to be this way, for the ability for multiple places to, start mining, or for the network effects to kick in, for people to price in the halving, and then the effects of the halving afterwards. There needs to be a certain amount of time to work through the market. Like if you think, okay, it's going to take a year or two to price in the upcoming halving, and then about 1 or 2 years for the effects of the halving to work their way through the Bitcoin economy, then it would make sense about 4 years. So that wasn't completely arbitrary either. And the last thing is the integer problem. So in Bitcoin's code, it doesn't, the block reward is not in Bitcoins, it's in Satoshis. And so why would you start with 50 instead of 100? Like you could just have a similar effect, but I don't know exactly how much more that would add to the supply if you did 100 for the first block reward, but it would be a lot, right? And maybe double. And the problem there is the Satoshis, the total number of Satoshis comes right up to that limit of the integers, the integer number in codes. And I have a link here. Let me go to this link in 8 decimal places. And I'll scroll down here a bit. So it's also worth noting that this decision means the total Bitcoin supply is approximately 2 to the 50.89 power. 2 to the 50th power, which means it's smaller than the maximum value for a 64-bit integer, which in computer is 2 to the 63rd power, and smaller than the first integer that can't be exactly represented in a double precision floating point number, which is 2 to the 53rd power. So see, if he would have done started the block reward at 100, there would have been too many Satoshis to fit into a integer in the computer. Like without, it says the standard programming languages can deal with Bitcoin amounts without requiring custom implementations or dealing with overflowing. So to get rid of those problems, he created it with 21 million. It was pretty much the biggest number that he could get in Satoshis. So what is that? Is that 2.1 quadrillion, or I think that's 2.1 quadrillion. I'm trying to count the zeros. Maybe it's 210 quadrillion. I don't know. It's some big number, right? And that's the most amount of Satoshis that you could have without causing these problems in the integer of the computer languages. And you were able to have the halving cycle, and you were able to do the 10-minute block time. So that the deeper down you go, you realize that this 21 million was not arbitrary at all. It was an elegant solution to a I hit my mic. Sorry, guys. To an elegant solution to this problem. How do you pick the supply? Well, let's figure out this to go through all of these steps that I just did, and now we're 21 million. That's pretty much the best answer. So another thing too is he's like, why couldn't it be something different? Couldn't the solution, like a linear not a halving, but it goes in a linear progression instead of a exponential type fashion? Yeah, that's possible. Okay, that's possible. Maybe he said also backwards, like have less inflation up front and more inflation in the back. Like what makes that the right choice? And there's reasons for this, of course, but that's not a significant difference. You can do that if you want. You can relaunch a new Bitcoin if you would like. What did I say here? Yeah, but it's not going to be much better. It might be a little bit better, but it's not significantly different to overcome the network effects that Bitcoin is already building. It has to be significantly better to lose Bitcoin, to lose its network effects to this new Bitcoin that comes out. So that's what I would say. And it's not arbitrary. It was a elegantly designed system. The deeper you go, the more you're like, holy crap, did Satoshi actually think about that? I think he did. I think he went through all of those steps. So anyways, what else do I have to say? So Bitcoin's properties, Bitcoin is not being centrally planned. It has a nature and it has properties. They are set, just like gold's properties are set. The thing is, Bitcoin can be built on top of and sent digitally through computers. So you can build layer 2s, you can build layer 3s, you can use open dimes, which I guess open dime would be a layer 2 because you don't need to send an open dime. You can hand an open dime to somebody, right? In the future, I guarantee you open dimes will be used physically to trade with people or something like an open dime. So yeah, that's what I'd have to say about that. Let's keep going.
Is that Bitcoin cannot respond to changes in except by changes in its price.
That was about a minute and a half left.
All right, thank you. Which means that with Bitcoin, volatility is not a bug, it's a feature. It cannot be stable. Its design is intrinsically not stable. And so, just to make my conclusion here, Bitcoin is a pyramid scheme. It does not generate or produce anything. Getting back to the debate proposition, I don't think there's any real debate as to whether gold continues to be for the next 100 years what it's been for the last 5,000 years. The only real questions are, one, when does the dollar collapse? And two, when does Bitcoin run out of fresh new blood and fresh new money to continue to feed the pyramid? Those are the actual questions that everybody should be thinking about.
Oh, God. Okay, so let me just make a few comments on that before we listen to Pierre. Pierre's comments, I'll have much less to say about Pierre's stuff because he's a genius and I agree with most of what he says. Oh my God, hold on. Okay, something was playing in my headphones. All right. Volatility is a feature, not is a feature, not a bug. Pierre actually later on, I don't think we're going to listen to this, the back and forth completely. We'll just listen to what Pierre had his first 10 minutes or whatever that he has. But he does concede this later on. He concedes that Bitcoin is volatile. And that is a feature, not a bug. And it's kind of good because you want, first off, I agree with Pierre, but you kind of need to have, a very sensitive price setting currency, or money. You don't want money that is too sticky on the way it adjusts to supply and demand in certain markets or whatever. So you kind of want volatility to a degree. You can always hedge that volatility risk away a little bit, but you want to have some volatility in an asset so that you can set prices. So prices give you information that you want, not too much where there's excess volatility, but you want to, it's kind of silly to think that you want money to have the same purchasing power for everything and all prices to be set and never change. Like, that's a dumb thing. You want prices to change because you want to know information about the market. Why have prices in the first place? But okay. So, but I want to take a different tact than Pierre for my main comments here on this about volatility. And that is that volatility is a good thing for a monetizing asset. You want number go up. That's all that really matters, number go up. Because if number constantly went down, it would never be adopted as a money. So the volatility is a property of a monetizing asset. As it matures, the small adjustments to the circulating supply can have a massive circulating value effect. And you'll get more stability. So this is the example. I hope that makes sense. Let me say it one more time, and then I'll give you an example. As this asset matures, small adjustments to the circulating supply can have a massive circulating value effect. And you will get more stability by just money coming in and out of hordes, right? As money comes in and out of hordes, it will have a stabilizing effect. So the example is, say Bitcoin has a market cap of 100 billion and demand rises, which makes the price rise. And he said the changes in demand can only be represented through changes in price. And that is incorrect, because you can change it by the amount of circulating supply. That's different than the total supply, obviously. It's the amount of supply to meet demand. Okay? Because of stuff in your hordes, I mean, it is meeting demand for long-term holding, but it's not meeting new demand, right? So to meet this rise in demand can be only met by circulating supply, and you can increase the circulating supply. So let me get back to the example. 100 billion market cap, and demand rises, making price rise. Perhaps this will pull some money out of hordes, right? Because then you can get more for your hoarded Bitcoin. So, and it pulls out 1% of the total supply, adds that to circulating supply. So let me give some better numbers here. So it's 50-50. 50% of Bitcoin is circulating and 50% is in deep cold storage. And the price goes up. Maybe now 1% of the total that was in cold storage comes into circulating supply. So now it's actually 51% of the total supply is circulating supply, and 49% is in the hoard, is in hordes. So that if the market cap is 100 billion in that case, that means there's 1 billion more circulating value to meet that new demand, and so that would push down on the amount that the price is going to adjust. However, when it's such a small market cap of 100 billion, that 1% change is tiny. 1 billion, that's not going to meet the demand of, say, $10 billion wants to, or there's the demand rises by $10 billion to buy more Bitcoin. That 1 billion in new circulating supply can't meet that. But what if now we say we have $100 trillion market cap? So instead of 100 billion, 100 trillion, and we have the same 1% change. So the demand rises, and now we have a 1% coming out of the hordes and going into the circulating supply. So it's still 51.49 at the end of this, but the amount that has changed, or the value that is now out there to meet demand, is $1 trillion worth of Bitcoin. So as the market cap goes up, as a asset monetizes and matures, I hope I didn't lose people on this because this is kind of silly, but as this asset matures and the market cap goes up, the effect of money going in and out of the hordes, going in and out of circulating supply, has a greater ability to stabilize the value. I hope that makes sense for people. Also, the higher the price, like if Bitcoin is $1 and the price goes up to $2, that's a 100% increase. $1 is a 100% increase. But if the price of Bitcoin is $100 and it goes up $1, then it's only a 1% increase, right? So the same amount of the same amount of movement is going to be less volatile as it goes up in value. There's so many ways to talk about why volatility will decline as Bitcoin monetizes and gets bigger. So, all right, that's that. I mean, I'm a person that thinks volatility will go down, but there's some people that think volatility will go up. In the Fugoid cycle, the volatility will actually increase as we go forward in time. But I don't buy that right now. I'll have to be more convinced in the Fugoid cycle to believe that. But anyway, so let's see. What else do we have? Therefore, changes in demand. Okay. At the end, I just want to say to the last thing about Keith Weiner here is that, when the dollar collapses, you don't hear anybody really talk about when the dollar is going to be backed by Bitcoin. Like that's a common theme in gold bug circles. James Rickards has made a career out of saying that they're going to remonetize gold and put back the dollar, or not remonetize, but reback the dollar with gold at a much higher price in dollar terms. That same thing can happen with Bitcoin, right? So the death of the dollar is not going to happen. The dollar's not going anywhere. The worst case scenario, I think, for Bitcoiners is that they back it by gold again. And of course, the best case scenario is backing it by Bitcoin. And even if they do back it by gold, it's not a loss. That would be a win for everybody. So anyway, okay, let's listen to a little bit of Pierre Rochard. I'm not going to have too many comments on his, but let's do this here.
Thank you, Keith. Now,
he calls him Paul.
Podium, Paul Pierre. You have 15 minutes to take the negative on the resolution. Have a chair.
Okay. Thank you. First of all, thank you, Gene Epstein and Soho Forum. I've attended two in the audience, and this is the first one I've had the honor of debating at. I also want to thank the Mises Institute for hosting this and for partnering with the Reason Foundation. It's very ecumenical. And thank Jeff Dice, of course, for the invitation, and thank Keith for coming to join us here and having this really important conversation. The Mises Institute has a very special place in my heart. I first went to Mises.org in 2005, downloaded MP3s and put them on my iPod, as one did back then. As well as when I was in college, I searched a dating website with the keyword Rothbard and found my now wife, and we have 2 children. So that would just not be possible without the Mises Institute. And I want to,
that's just so boss to me. Like, he is the man.
Especially thank the donors and the scholars and the students here. This does affect people's lives, and it is important work that you are all doing. Okay, so a little bit about me. I've been researching Bitcoin since 2013. I'm now the Vice President of Research at Riot Blockchain. It's one of the largest publicly traded Bitcoin miners. But like Keith, I'm not here to shill business. And here's my contact information if you want to contact me. So I think that the first really, maybe this is a separate debate, but it's a debate within a debate, is what is money? What's our definition of money? And if you attended Professor Klein's excellent lecture on money yesterday, my impression was that she gave the consequentialist definition, which is really kind of what is the end result of the market process, is that you have an asset that emerges as the most saleable, marketable liquid good. And really, I think that's a fine definition of what money is in kind of equilibrium. But as we know, market processes are not in equilibrium. And if we think about from a first principles perspective of why do we hold money, I refer back to an excellent article written by Hoppe about the yield on money held, which is an article written by William Hutt, whose name I see here. And it's really about hedging against uncertain future cash flows. So we have a lot of uncertainty in the world, and uncertainty has a very specific definition that we would contrast with risk. Uncertainty is unquantifiable. You don't know the possible range of outcomes. Whereas risk is quantifiable. You can have actuarial models and be able to price risk, whereas uncertainty is something that is uninsurable. And the reason we hold money is because there are future cash flows that are uninsurable. If all future cash flows were known, right, in the evenly rotating economy, then we would be able to not have to hold money because we could prearrange all of our transactions so that, we always have this intertemporal double coincidence of wants, which is obviously completely unrealistic given the world that we live in. So we have to hold money, and it has to be, if we're hedging against uncertainty, I would argue that the money that we have to hold has to be the least uncertain asset possible, right, available to us in order to most fulfill the need, the utility of hedging against uncertainty. Okay, so.
All right. What just next level? Like listening to him versus Keith, I just think Pierre is next level. I mean, he's citing different thoughts by different people, especially being that this is a sponsored Mises event, and these people would be more inclined to be Austrians than to be Bitcoiners, that he is appealing to the audience, which is very good. And let's see, what else did he say there? He said about uncertainty, and yeah, he's attacking it from this Bitcoin is better than gold. And I agree. But that is not the resolution. The resolution is that gold will not be a important money in 100 years. Very different. Very different. Again, for people that joined later, I said, is Latin an important language? Even though it's a dead language. Yes, it is. Depending on what you mean by important. So Pierre is arguing this resolution from the perspective that Bitcoin is better than gold and will steal gold's monetary premium. And I agree with that. But that doesn't mean that gold is not important or that it will stop being important. And I personally don't think it will lose 100% of its monetary value within the next 100 years. So, there's always a slight bit of risk. Like, what about if there is this risk of quantum computing, or there is a risk of SHA-256 getting broken, or there is a risk of some of these other things in Bitcoin, like there needs to be a hard fork in Bitcoin for something in like the year 2034, and I can't remember what it is now. Good Lord. But there is going to have to be a hard fork to Bitcoin in 2034-ish. I think it has to do with a date bug. But so there is some uncertainty in Bitcoin. And that's where gold, I think, will keep 1%, 2%, 3% of its monetary premium just because of that slight bit of risk that Bitcoin actually fails. But everything else will be monetized over to Bitcoin. So will gold be an important money? I think it will be. So I would have to agree with Keith in the resolution aspect of this. But Pierre is obviously putting on a masterclass here about money, about Bitcoin, and it's great. So let's listen to some more.
Let's kind of dig into uncertainty in a monetary system. I see two places where uncertainty arises when using a money. One is when you're actually holding it, right? And I mean that, very literally, of when you have money on your balance sheet as an asset. And then the second source of uncertainty is when you're actually transacting with it, when you're sending it or receiving it. And these two axes when we evaluate which assets minimize uncertainty on these two axes, this is a subjective evaluation, right? We're engaging in entrepreneurial activity, and we might be wrong about which assets have more or less uncertainty. And so I really see today's debate as an entrepreneurial debate rather than really one about theory or praxeology. Okay, so let's get into, well, I'll elaborate here as well, although I already touched on some of these topics. Professor Klein had this excellent list of different qualities of money that would allow it to emerge as the most saleable good. And I think that on each one of these qualities, we should look at it through the lens of how do we minimize uncertainty, right, in all of these regards. So my central contention is that receiving, holding, and sending with Bitcoin has less uncertainty than with gold. And from that, I would expect that the market process would, over the coming years, and I think that the proposition is 21st century, so we've got the years are ticking by, but we've got 70-something years remaining of market process before we can finally decide whether Keith or I was correct. But that if Bitcoin really does fundamentally have an order of magnitude less uncertainty than gold does, that we would expect Bitcoin to demonetize gold. And I would argue that silver has been demonetized already. And if I really wanted to throw a bomb, I would argue that the dollar has already demonetized gold. And it's only recently that gold has reasserted its monetary premium, in post 9/11 world. But that really, at 2000, when Tony Blair was selling the UK's gold, that maybe that was peak demonetization of gold. But I'll let Keith pick on that thread if he finds it to be silly. So let's look at it. Let's look at the uncertainty when we're receiving an asset. This was highlighted by the professor that came after Professor Klein, but I should have Newman, I believe. He pointed out the issue with counterfeiting. And when we're dealing with a monetary asset, it's critical that we're able to verify the authenticity of that asset, that we're able to combat counterfeiting. And here I really think that gold has an issue of cost. It is very expensive to verify.
So for guys listening and not watching, on the right of his slide here, it says assay and sonogram for gold costs about $3,000 to $8,000 to manually verify the gold you receive, but it's impossible to audit the total supply. Where Bitcoin, not only can you automatically verify all Bitcoins, but you can audit the total supply of all Bitcoins. Now, the response to this, which I'm not going to show because we're going to be done here after this segment from Pierre, but what the response to this was Keith took out a gold coin and he's like, oh, but I can just listen to the sound that it makes when it falls or when it clangs on something. True. But that if that proxy, it's not perfect. Obviously, that would not be perfect. A perfect way to know that this is 100% all gold. Like, what if it was this gold coin, instead of being 90%, it was 85%? That sound that it made would still be very similar. The alloy I'm talking about of 85% gold. So no, you can't trust that. Plus, you can't do the entire supply. You can't validate the entire supply. You can only validate what you are holding. And counterfeiting, as Pierre is pointing out here, counterfeiting affects the entire supply. So anybody counterfeiting anywhere affects you, not just the coins that I can drop and test the sound. Plus, another thing, look at I'm saying this for the people that don't have the pictures here, but he has a picture of a large gold bar. Are you going to drop that and listen to the sound that it makes, Keith? Or are you going to have to take that gold, make coins out of it, So that's not even validating what Keith is saying or what Pierre is saying here. So let's continue.
The purity of gold, and
Correct.
that doing an assay and doing an sonogram of your gold bars and gold coins, inconvenience aside, is very expensive, and it's something that you would have to do every time you receive gold, right? Now, furthermore, it has another limitation, which is that even when you do verify your own gold, you're not verifying everyone else's gold. So, as it was pointed out, the counterfeiting negatively affects all gold holders, right? Not just the ones that are being cheated by receiving counterfeit gold. So I would contrast this with Bitcoin, where you're able to cryptographically verify the Bitcoin that you receive using what's called a Bitcoin node. And in this, with this software, you don't need to trust anyone. You're able to firsthand verify not only the authenticity of the Bitcoin that you are receiving, but the total supply of Bitcoin as well. And so this really makes it an order of magnitude less uncertain than gold. And it's easy. It's automated software. So, and it uses cryptography, and it's, as far as we know, foolproof.
There he said, as far as we know, foolproof. Well, that's that little bit that won't be demonetized of gold, is as far as we know, right? That's the tiny little 1% or even 0.1% chance that Bitcoin will fail or some major thing will go wrong with Bitcoin. So there's always going to be a room for a tiny little monetization in gold.
All right, let's go to storage. Has anyone here bought a gold vault? They are very expensive if you want one that is of quality. It has limitations. For one, the gold vault is in one singular location, right? Fort Knox is in one location, which might seem like, okay, well, why is that a problem? With Bitcoin, you don't have that limitation. With Bitcoin, you can actually put what are called private keys, which allow you to unlock Bitcoin. You can put those private keys in any number of different locations. And this is a really tangible advantage in terms of security. Professor Klein mentioned that one of the reasons why people don't carry gold around is that it's very hard to secure gold. And I was recently on vacation in France. I was reading about the local history, and there was a chapter about the problem of theft in this part of France, and that farmers could not leave their farms because thieves would come along, break in, and steal their gold. So the locality of gold, the physical locality of gold, is a problem. It's one that is, solved by the nation state, which I know that here we would frown upon, but that's the reality of the situation that we're in. Furthermore, one of these vaults only is rated to last 30 minutes against power tools. So if you are not home and the police does not arrive within 30 minutes, they will break into the vault and they'll be able to steal the gold.
I wanted to add here that the physical nature of gold actually was a benefit, in the past, because it was a way to have a fixed supply, at least have some sort of fiscal restraint on fractional reserve, right? Or physical constraint on fractional reserve. That physical nature was a constraint. But today, with Bitcoin, you don't need that. And now the physical nature has turned into a weakness for gold. So let's continue.
Which means also that if you are dead for whatever reason, right? Perhaps this is a home invasion and the home invader, is a criminal and murders you, then they can still access your gold, right? That's not necessarily the case with Bitcoin, because with Bitcoin, if you had memorized the passphrase and they've murdered you, now they can no longer access the Bitcoin. Which also leads us to the final point here on the gold side, is with regards to pleading the fifth. This is relevant in the United States. I'm sure that there's different degrees of relevancy outside the United States, but in the US, you can plead the fifth in order to not give a password to the government, right? So if you have your Bitcoin locked away by a passphrase, the government can't force you, compel you to give up that passphrase and seize your Bitcoin from you. Whereas with gold, all they need is a search warrant, and they can certainly seize, gold from a vault. That's unfortunately in the Constitution. Okay, now on the gold side, there's really easy ways to store Bitcoin. You could just use your phone, right? There's lots of great Bitcoin wallet apps on your phone that allow you to hold your private keys there. But that would not be minimizing the uncertainty, right? Because phones are actually one of the riskier ways of holding Bitcoin. The most secure known way to hold Bitcoin is to use what's called a multi-sig, which allows you in a programmatic way to say, in order to spend these Bitcoin, you need 2 signatures from any 3 different devices, right? And these devices are generally called hardware wallets or signing devices. Here I've got, for example, the cold cards. And this multi-sig, I use 2 of 3 as an example. It could be 1 of 5 or 10 of 15. There's any number of different combinations that one could have in order to, again, minimize the uncertainty. You can do neat things with multi-sig. You can leave private keys in different legal jurisdictions so that in terms of asset protection for the government to seize your Bitcoin, they would have to go through international legal process to seize all of the private keys and be able to move the Bitcoin. This cold card, this latest generation, as far as we know, can resist power tools and lasers for an indefinite period of time. So the attacker would sooner accidentally destroy the private key than be able to extract it from the device, just making it an order of magnitude better than the vault. And it's, again, inaccessible if you're dead, and you can plead the fifth.
One of the things I want to add here that Pierre didn't touch on is the fact that this increases the cost to the government or to the attacker, whoever that attacker is, whether it's a criminal or, I guess, a government criminal, government corruption, because they can always get to your gold, they can always get to your dollars, and sell that in order to pay for their enforcement, right? But they can't do that with Bitcoin. That threat is that they will waste the expense of going after you and not get your Bitcoin. That's always a threat. And just that little bit of uncertainty for the attacker will change the fundamental payoff of criminal activity in the first place. So that's one reason why people think Bitcoin will lead to a more peaceful world, which I think it will to a degree, because it changes the calculation, the cost benefit analysis of the criminal. So anyway, let's continue.
Okay. Sending gold versus sending Bitcoin. When you are sending gold, you are generally recommended to use registered mail through the U.S. Postal Service. And that's maybe a little bit status, but if you use FedEx or UPS, they're apparently much harder to work with. Much more expensive to ship gold, it takes much longer, and you're trusting the US government. With Bitcoin, you can send billions of dollars worth of Bitcoin for very little, right? Anywhere from pennies to dollars worth of Bitcoin in transaction fees, because the fee is based on your data usage. It's not based on the value that you're transacting. Generally, it takes anywhere between 10 to 30 minutes to move your Bitcoin around. It operates 24/7, and you don't have to trust anyone. You just have to trust your own software. You could write your own software if you want to. Plenty of software engineers have written their own Bitcoin node implementations and Bitcoin wallet implementations. It's all free and open source.
It's time to introduce you to the new Patriot.
Another ad. I'm obviously not on my account here.
Okay, so just to kind of diagram it out, my contention is that Bitcoin has an order of magnitude more certainty than gold in practice. And so one would expect that gold will replace Bitcoin. Or sorry, Bitcoin will replace gold. Brain fart. Okay. Now, let's now go to, well, don't I go to the rebuttal or, okay, so now it's Keith's turn.
Okay, that's it. Clap for Pierre. That was very well done. He had a very hard task, though, of course, because, like I said, the resolution is not that Bitcoin will outcompete gold over the next 100 years. It's that gold will not be an important money, which is a completely subjective claim and probably correct. Like that gold will still be a important money in 100 years. But anyway, so that was interesting from Pierre's perspective. He really concentrated on uncertainty and, of course, the price to secure, the price to transfer, the price of just the cost of all of these things is just so much better with Bitcoin. And yeah, so I went through all this stuff prior. So if you're catching this towards the end, guys, just rewind to the beginning. I went through Keith Weiner's comments, and I'll just summarize them here really quick. So he said 5,000 years. He kept saying 5,000 years, 5,000 years. That was a big thing. He's like, oh, it's been around for 5,000 years. It's going to be around for another 100. And yeah, okay, that's true. But it hasn't fulfilled the same role for 5,000 years. It's changed dramatically over those times. And over that 5,000 years, he also said that people will turn to what's held value for 5,000, what they've saved in for 5,000 years, and that is gold. But people have saved in all sorts of things, in almost an infinite amount of things that people have saved in, not just gold. Gold being, to compare apples to apples, you would have to compare the classic gold standard, which lasted for what, say, not even 100 years. Wasn't it like the 1870s through 1945 or 19, would you say 1933? I don't know exactly, but the classic gold standard didn't even last 100 years. And so that would be more of an apples to apples to Bitcoin's 13 years. We're not talking 5,000 to 13. We're talking 60 to 13. That's apples to apples. So anyway, what else did he say? He said, of course, he talked about the dollar being designed, it's controlled and rigged, but somehow these omnipotent central planners of the dollar, the Federal Reserve, they can't control it. They've never, ever once hit their 2% target, on a year-over-year basis, like exactly 2%. Even an annualized month-over-month basis, they haven't hit 2% exactly. So, no, this isn't designed. It isn't controlled. It isn't all these things. It's naturally evolving money. It's a naturally evolving process. And just because you bet on the wrong horse, say, or you believe in the wrong horse, then somehow it's 100% rigged. But that, of course, is not the case. It is, let's see. What else did he say? I'm just trying to sum up all of his points. Savers will turn to gold. We covered that. Financialization. He talked about financialization. And so Keith Weiner talked about financialization. Because there's no yield left, because the Fed controls everything perfectly, exactly what they want. They rig the game exactly how they want it to happen, right? That's what we're supposed to believe about the Fed. That since interest rates are so low, then people had to go out and play the speculation game to try to find yield. But remember, interest rates are low because money is tight. And in a credit-based system, when money becomes tight, people start searching for monetary premium elsewhere. If there's a dollar shortage, you look for money elsewhere. And so these monetary premiums start popping up in different things because there's a monetary shortage at the end of a credit bubble and money is tight. So see, if you think that way, you don't have to believe in any of this conspiracy stuff or any of this intricate manipulation and control of the market. There's some sort of huge collusion going on, which collusion always breaks down, so that can't be the case. And okay, so that, oh, and also that this is the case of financialization fits perfectly with a deflationary thesis, where an inflationary thesis for the dollar does not, because in the inflationary thesis, you try to get rid of cash and get into something that's going to hold its value. Where in a deflationary environment, you get this speculation. You get this trying to find where the monetary premium is going to come up next, right? And so you're trying to find some new monetary value someplace. That's what we see today. We don't see, this is not an inflationary degradation, it's a deflationary degradation. Okay, what else did I'm just trying to sum up my thoughts here. He talked about Bitcoin, of course, that there's no creative or competitive thing generated by Bitcoin. But of course, we know involuntary transaction, there's an increase, mutually beneficial increase in utility for both parties. So that cannot be the case. It literally cannot be the case, definitionally. He complained it multiple times about being a rigged game, but life is not fair. There's always going to be winners and losers. Then he tried to say that there is no diminishing marginal utility for gold, as if it has a magic property. And I said, no, that's not the case. That diminishing marginal utility comes from, it's just because the unit is too small, right? He's like the nth ounce and the nth plus 1 ounce is going to be the same price. Well, yeah, but he used the example of water and liters, but these liters are a big thing of water. If I'm thirsty, 1 liter is going to, stop my thirst, quench my thirst, but not 1 molecule. So the diminishing marginal returns apparently disappear, if you use a small enough unit. That's just what you have to do with gold, because if you say tons, all right, tons of gold, or we could even just go bigger, 1,000 tons, then it becomes even easier to see. But 1,000 tons, and you keep adding 100 blocks, bars, whatever, big truck beds full or whatever of 100 tons of gold, then you can see that the marginal, you would start to see the diminishing marginal returns. You just have to have a big enough thing. So gold doesn't have a unique property, magical property. It does have a quite unique property in different things, but that is not one of them. And what else did I said, had an example of that, or let's see. Diminishing marginal returns. Let me find my notes on this. Okay. Yeah, he said there's with no apparent limit to this property in gold, but I said that doesn't mean there is no limit. It just means there's no apparent limit. Also, that markets, this magical property of gold, isn't actually present in gold. It's present in the market. The market works to find the right amount of supply new supply come to market to meet the demand. If the demand fell out through the floor and the price dropped or whatever, there would be less mining happening and the price would right itself back to relatively stable value. So this is a market process. This is not a gold process. And that same process will work with Bitcoin. It definitely will. Another thing I said that he conflates supply, total supply to circulating supply. He conflates price and value, which value is subjective and created in the minds of men, where price is just the marginal clearing price for supply and demand. Okay. Also, I said 21 million is not arbitrary, because people always say that, oh, why is it 21 million? Well, it has a lot to do with block times, with halving cycles, with monetary logical arguments about diminishing inflation instead of increasing inflation or linear inflation. There's monetary logical arguments around that. And big thing is that when you talk about sats and integer limitations in coding language, once you combine all of that, then it comes out where you have to start at 50, and 50 with the halving cycle and all of that and the 10-minute block times comes out to 21 million. So it's not arbitrary. 21 million is the process of many different factors, or the result of many different factors. Let's see. Volatility being a feature, not a bug. He says that Bitcoin is designed to be volatile. Pierre, later on that I didn't show, he actually does say in there that he concedes that point, and he doesn't mind that Bitcoin is volatile. But I think I am in the camp that Bitcoin will become less volatile with time, mainly because of a higher amount of market cap will not only make price movements a smaller percentage of the price, but also that as hordes come into the circulation supply, and then sometimes the circulation supply goes into hordes, that has a modulating effect on counterbalance to demand. So the price can stabilize out as the market cap goes higher. Okay, I am about pooped. This is the longest live stream I've done in a very long time, and I think it's my first weekend live stream. So hope you guys enjoyed. Thanks for hanging out with me. And yeah, that's it. Of course, check out the original video because they go on more to talk more in depth about these issues. And the result is Keith wins the debate, but I think that's because it was a bad resolution, and I even would agree with Keith. So anyway, that's going to do it, guys. Check out bitcoinandmarkets.com. Support my work, share my stuff out there. Appreciate everyone hanging out in the Telegram, t.me/Bitcoin and markets. That's going to be it, guys. I'll see you tomorrow. Later.